everybody. Welcome to the NREP Daily here on the National Real Estate Post. Once again, Saturdays with Barry, and we need to talk about what's going on this upcoming week, Barry. You said something to me before we started this. I'm like, haven't really heard that in a while. So why don't you just let them have it, man? What do you think's cooking this coming week?
So this coming week, I'm just looking for potential small pullback in mortgage-backed security pricing. Just be careful. Every time we get to this level that we're near right now, we seem to have a little bit of a pullback. So because of that, we're just playing it a little bit cautious. I'm not saying to panic or anything like that. And I do think whatever pullback that we do get, we will probably overcome. However, if you've been enjoying the nice gains that we have gotten, this might be a time to just watch things a little carefully, maybe see a little bit of a pullback. Stock market, although there was a pullback on Friday in the stock market, it's still on this crazy upward trajectory. It's still in a positive trading range with just this up escalator that it's been on. It's mind-boggling, so to speak. But one of the things that you have to watch for is Congress is in session just till August 7th. They just come back, they just work a little bit,
right,
and then take more time.
It's overwhelming. You got to take a break.
You've got to take a break. You got to. So, but here's the thing: they've got a lot on their plate, and we know just by looking at some of the numbers, the jobless numbers, that 32 million people, 20% of the labor force, is receiving some type of benefit, and PPP money is starting to reach a stage of running out of the period of time where they've had it. So that money is getting dried up. And there are many zombie businesses that really were keeping employees there just because of the PPP money. And
right,
you have to watch to see which way this goes. Is it going to be extended? Is it going to be different? What's going to happen to unemployment benefits with this supplemental amount? It's going to be $600. You're going to knock it down to 240. What's going to happen here? And this could change the trajectory of the stock market, and it could also impact people's ability to purchase a home too. So we've seen the housing market's been really strong. It will continue to be strong. Remember, this is something we're going to get past, but there could be a period of time here where the seriousness of the level of unemployment without a safety net could be exposed now. Now, I think that Congress will do something. I do believe that something will happen.
Sure.
The reason I bring that up is because if it does, then the stock market loves this kind of stuff. So if the stock market could rally, and people that are invested, some in bonds, some in stocks, big institutions could say, hey, I want to catch some of that tailwind.
Right.
Let me because I'll get faster returns, may pull some money out temporarily, the bond market, put it into the stock market. And as a result, we could be in for a little bit of a bumpy ride in mortgage-backed securities, which have been great. You and I were just kind of joking about that. It was just a little over a year ago when you guys had me on the show, and we talked about 1% on the 10-year Treasury.
Right.
Like you guys thought that was never going to, and sure enough, we hit that. We hit all the way down to 0.31. 10-year Treasury
unbelievable,
below 0.6 now. I think we will challenge 0.5 eventually, but listen, we can't let our clients kind of get lulled into this false sense of security. Let's remember, one of the things that we always have to think about is supply and demand, right? Now, we know that that's true in the housing market, and the housing market is very strong because simply more people want to purchase homes than there is demand for homes. And right now, 35% of those purchases are first-time home buyers, a lot of people getting out of renting. Multifamily is not doing very well because part of that is the rental component, people worried. So we know supply and demand really plays in the housing market, but let's not forget that it does so also in the mortgage bond arena too. And everyone listening has done such a great job on the mortgage side of helping their customers by refinancing them and doing so much of this. And many people are having record closing months, record closing months, record closing months. We've heard that for the past 2 or 3 months. So what happens? These things in the interim are now getting bundled into securities, which have to come to the market. There's an appetite for it. But remember that just an overabundance of supply may cause some ripples in the bond market where everybody said, oh, rates are going to go lower, rates are going to go lower, rates are going to go lower. And I think over time, as this gets absorbed, we probably see some very favorable rates, but we could see a lot of supply coming to market and a little bit of a back off. Now, we see this kind of interesting dynamic that occurs, Frank, and we've talked about this. why would people want to invest in a 10-year treasury at 50 basis points? Or,
Right.
you know, have you seen this thing in Austria? They have a 100-year bond, 100 years, and the yield is a whopping 0.88. So people say, well, why would I want to do
What
that?
are you thinking? Yeah.
Well, here's the thing. Normally, we would look at the yield, but we have to throw out conventional wisdom because everything's upside down now. People do not buy bonds anymore because of the yield. They buy bonds almost like a stock, because what they're thinking is that, you know what, if that yield drops further, and there is thinking that it drops further, if it goes from 0.88, let's just pick a number, to half that, 0.44, guess what happens? You make capital appreciation. In other words, the paper you're holding at 0.88 for 100 years, let's say you've invested $100,000.
It's more valuable.
Maybe $200,000. People are buying bonds for capital appreciation because they think rates are going lower. Now, what will happen, brother, is that if whatever causes things to go the other way, it will unwind quickly, and we could be in for some shocks. If people think, oh, well, rates aren't going to go lower, they'll dump those securities, because just like you can make a lot of money if rates go down, you can lose a lot of money if rates start to go up.
Gotcha.
So, you know, we have to understand that that when it happens fast. So that's why we have to be nimble right now. We just have to tell our customers, please don't fall asleep at the wheel here. We think things look good. They should be good, but goodness gracious. You know, we talked about this in the past. If you wait, and let's say you're right and rates drop another eighth, the money that you've lost in the interim, even if it's a few months, it takes you like 4 years to make up the money that you've lost over 3 months. And this applies to you if you're talking to a customer and they're saying, you know, well, maybe I'm going to leave you to go someplace else because I can't get the lower rate. Well, first of all, you don't, not guaranteed that. But even if you were, if it takes you a couple of months to do that, remember that's a couple of months of savings you would have had. It might take you a couple of years to make that up for the incremental gain in rate. So these are things we want to discuss with our customers. And I think it's very important right now that people not be pigs about this. Okay, just let's really, I'm talking about customers. Don't be pigs about this, because yeah, we want to get a great deal, but you know, if your rate is 2 7/8 or 3%, I mean, really, is that going to be life changing? But what if it went up 0.5%? That could be a big difference in missing out on making those savings. Yeah,
you know, I think another thing to just, obviously that's great advice, you know, for the loan originator to give to the customer, and it's great advice for the customer if consumers happen to be watching this. But something I just wanted to you made me think about in this conversation is having kind of this you know, attitude of you know, I'm gonna you know, try and get as much as I can out of this, you know what I mean? And give me your feelings on this. It's like it came up multiple times in the news lately where, you know, we're trying to squeeze, you know, $3 trillion worth of projected business into, you know, a $2 trillion size pair of pants here. You know what I mean? And I guess where I'm going with this is that the loan originators today are just so crazy blessed to be in this industry, right? And there's so much business that's just literally falling out of the sky into their laps right now, and they just have to tend to it. I get it, right? We have to get it. But I was trying to find, and I couldn't find it, maybe you're aware of it, like overall in the country, what the purchase to refi ratio is right now.
Yeah, 65%.
Is it? So 65% refi. That's not as bad as I thought that it would be, in all honesty. Because I was thinking, man, what if this is like 70-30 or something like that, or, you know, or 75-25? You know, at some point in time, the mortgage industry and the originators out there, they have to try to find a way to, you know, pay some attention to the purchase side of things here. You know what I mean? And not lose sight that there's partners out there that are going to need your help. They need your help right now. And, you know, the ones who are there to help them today are the ones that are going to be, you know, benefit, you know, when, if it ever happens, if it ever changes, right? If rates ever do go up, right? You know, and so I guess, you know, I just hope that our originators out there aren't feeling like this is just going to last forever and, you know, getting too greedy, like you said about the customers, maybe wait until it gets lower to get too greedy. You know, getting too greedy on the refi side of things. And they really are thinking about trying to find ways today to make sure that they have something sustainable when things change. Because there's, even though the overall, I know you want to say something, but overall, if it's 65, whatever, 35, right? I can assure you that there's a large number of originators in that are doing way more refi than like there's originators that might be 100% refi right now. You know what I mean? 90% refi right now. And so those are the guys that I'm concerned about. And those are the guys that I hope can really hear us today and understand things can happen so fast. And like you were just saying, things can happen quickly, you know, where all of a sudden, you know, you could be standing around, you know, with your jaw hanging open going, what the heck just happened here? So that's all.
Yeah. So you said so much good stuff there, and it's just wise experience that is, and I'm hearing you, and everything you're saying is just resonating, and it's really, really smart stuff. So let's unpack a few things. So first of all, to be clear, I think there might be some speed bumps. I do believe rates will be lower than where they are now, believe it or not. Whether we get that because of capacity issues, I'm not so sure it gets passed on, but the natural market will want to head lower. But let's face it, if we start refinancing and doing purchase business and all the rates are, you know, wind up being a majority of them under 3.5% over a period of time, of the next 6 months or so, then rates don't have to go skyrocketing. Heck, they can go to 4%, right? And now we're very, very slow. Look, let's remember just 18 months ago, not 18 years ago, when rates were 4 3/4, 4 7/8, 5%, not a bad rate at all. You know, take it from guys like you and I who've been doing this for a long time, we would have killed for those kind of rates, right?
Yeah.
The market was really slow. I mean, people were leaving the business. I met a guy in the mall who was working at Foot Locker. He couldn't cut it as a mortgage professional anymore because exactly what you're saying. He had the whole zebra uniform on and everything. So it just, everything that you're saying here makes so much sense. But here's what it is. It's not sacrificing one or the other. You have to do both great. Yeah. I agree with you. There's a lot of people doing too much refinances, but I'll also tell you there's a lot of people doing too much purchases. And there is such a thing because you're not servicing your customers. Sure. You have to do both, and you have to do both great. This is the time to raise your game. Anybody who's heard me speak over the last couple of years has heard me say, this was coming, number one. Don't do any upfront MI, take monthly MI. Don't do points on loans, and do as much as you can to the extent you can, where you can include closing costs. Because I said you're gonna have this unbelievable boom, and now we're in the thick of it. And the advice right now is you have to rake the money in with both fists, but you have to do both great. You can do exactly what you said. Don't neglect your purchases. And if you're doing too much purchases, don't neglect your refinances, because your past customer database is gold for you too. So you just have to really work your butt off.
Trying times.
Right. This is a high class problem to have.
It really is.
Just remember 18 months ago, remember the Foot Locker person I talked to you about, and you can really build the future. But here's the other thing, and this is really where it's important. What are you doing with the money you're making? Because you're making money right now. And there's a great book to read. I'd love for you to read my book.
Besides yours.
Money in the Streets right here. But there's a great book to read called Richest Man in Babylon. It's really easy. You can read it in an hour. I used to buy it for all my customers and give it to them. And really the theme of the book was to pay yourself first. Make sure that the first bill that gets paid, before your mortgage, before your car payment, before your credit, is the bill to you for your future. So that's the first thing you do, is you put money away for yourself. And what I want people to understand, we've got a great tool on MBS Highway, which is a retirement calculator you can use with your customers and show them, but really use it first on you. How much money do I have? When do I want to retire? What's that going to be worth? And then how much money do I need to be saving each month to generate this much income for the rest of my life when I retire? Because now's the time where you could set up the rest of your life. So if you're making money, I want you to ask yourself, what are you doing with it? Are you putting enough away during this time to protect you and your family for the rest of your life? Because this is the gift you've been given right now. And this is the time for you to do it.
Barry Habib. Thank you, sir. Always great to have you on the show. Guys, I'll put a link down below to MBS Highway, of course, and also to Barry's book, so you can buy that book as well. But thanks so much, man. Always appreciate you being here. I know everybody appreciates what you got to say. So once again, thank you, and we'll see you next week.
See you next week, brother.
All right, you guys have a great one. Leave your comments down below, forward, share, and subscribe. We'll see you soon. Adios.